Welcome back to our second example of a capital budgeting solution. This is a more complex problem and a more complex example. My objective for you is to be able to read this, understand it, and answer questions about it, not necessarily be able to duplicate this within an Excel schedule, but certainly be able to read it and interpret it. So let's take a look through some of the basic assumptions. First, we're looking at buying an asset for $450,000, and doing so will let us increase revenues the first year by $975,000. The question is, should we buy this asset or not using our capital budgeting decision rules? Some of the assumptions that go into this is that after the first year, revenues will grow by 15% per year. Our gross profit on these revenues, that's our revenues less our cost of sales, would be 39%, and our selling general and administrative expenses as a percentage of sales would be 18%. All of these items are assumptions in arriving at the cash flows that we will then use to analyze the project in accordance with our capital budgeting decision rules. The next item is our capital, the money we're going to put into this project. And this is new, but we should be able to follow it along. We're saying we're going to fund this project with 40% of our money borrowed from the outside at an 8% rate. And the rest of our money would be equity money. That's money contributed by owners, and our owners want a 24% annual return. So we say 40% of our money will be at 8% return to our lenders, and 60% of our money to fund this project would be a 24% return to our equity holders. Our depreciation in percentage per year is listed here right from the depreciation schedule. Our state income tax rate is 6.5% and 34% federal tax rate. And our combined tax rate, as we covered in a previous section, is listed here. Our working capital balance is going to be listed as a percentage of sales. So as each year's sales grows, we're going to need more working capital, and we're saying it's a 1% amount of sales. In a prior year, we had a feasibility study of $150,000. We'll have a lost gross profit at externality on other products where by doing this project, we will lose gross profit of $75,000, and we will have an opportunity cost of $90,000 for the space. If we did not do this project, we could lease it out. When we're done with the project, after 9 years, we can salvage it for $265,000. So let's stop back for a second. Take a look at the type of variables we're throwing into this. We have an initial cash outlay. We have a revenue algorithm. We have a cost algorithm in both gross profit and selling general and administrative expenses. We have the components of what our cost of capital would be, given our cost of equity and our cost of debt. We have a depreciation schedule, tax rates, a working capital requirement, an old feasibility study, which we'll see is a sunk cost, an externality, an opportunity cost, and a salvage value in a life. The question is, should we do this project, yes or no, based on these assumptions? And we're going to take a look at it in light of the capital budgeting decision rules that we've previously covered. So let's go ahead and start scheduling some of this out. If we move forward to do that, we'll sketch out the initial cost of $450,000 and look at our working capital requirement. That's based on the anticipated sales, 1% a year later. This will increase as sales increases over time. You can go back and take a look at the computations on this. We list our revenues, less our cost of sales, less our selling general administrative expenses, and check here we take out the depreciation expense, which has been computed pursuant to the maker's depreciation schedule. We also take out our interest expense. We assumed that we were going to spend 40% of our money on interest, so 40% of the requirement will go to interest, and that's computed here, and here's our interest expense. And we have our pre-tax cash flow and our tax rate and our after-tax cash flow, and then we take a look at our working capital requirements. Now, this is the major point. This schedule more parallels an income statement for financial reporting purposes. It is not yet in the form that we can use to apply our capital budgeting decision rules. That's why some of the items in here are relevant, some of the items in here are not relevant. We have to go through a conversion process to change these numbers into the format that we can use for capital budgeting decision rules. So let's get started doing that. I'm going to slide up just a little bit. We start with the net income per above, our bottom line, and we want to get back to a base figure. So let's add back in the taxes, let's add back in the interest, and come up with earnings before interest and taxes. We now ignore the sunk cost. It wasn't in there before, but I'm just pointing out that we do not put it in. One of the objectives of this problem, and also something you'll see throughout the course, is that the problems and often real situations in practice throw us a lot of information that we may not necessarily need in the solution of a particular project. In this case, we were given an item of an old feasibility study, a sunk cost. We need to know to ignore that cost. But the opportunity cost of otherwise leasing out the property, that is a real cost for capital budgeting decision rules, and we're going to put it in as a cost. And there is our lost opportunity cost of leasing out the space. We also have an externality. This is the lost gross profit on the other product that we will lose by going ahead with this investment. We show that here as a cost, even though it did not appear on the financial statements. Notice that we have two major cost items here, our opportunity cost and our externality, which did not appear in the income statement above, that we're going to add in here because we know to do so. That gives us a new pre-tax income, and we go ahead and compute our tax benefit or cost based upon those numbers. In our course, we assume that if there's a loss, we can get the tax benefit of that loss immediately. In practice, there are a lot of conditions to be able to use that loss, and I ask you just to keep that in mind. So here we have our relevant after-tax cash flows as we move forward to our capital budgeting decision rules. But is this our final adjustment? And the answer is no. In order to arrive at the tax number over here, we still had depreciation expense embedded in here. Now we have to add back the depreciation expense. And once we add back the depreciation expense, we're able to go ahead and come up with our relevant after-tax cash flows. Take a look at period 0. We list our initial cash outlay, the $450,000, and the working capital requirement of $9,750, and our continuing growing working capital requirements. At the end of period 9, we take a look at salvaging it for $265,000, and that salvage value gives rise to a tax bill on the salvage of $101,000 that we also have to show. And I'll go over that calculation in a minute. When we add all that up, we get these numbers across this row, which are the relevant cash flows for application of our capital budgeting decision rules. The major point of this is that we cannot use these income statement numbers that we saw up here. We have to go through all of these adjustments and these type of adjustments to come up with relevant free cash flow for our capital budgeting decision rules. And now we go ahead and apply those rules. One of the first things we do is compute our weighted average cost of capital. If we take a look at our cost of debt, we then see that it was 8%, but on an after-tax basis, 1 minus the tax rate, we then have 4.94% as our after-tax cost of debt. We weight that at 40%. Our Pre-tax cost of equity is 24%. There is no tax deduction with respect to dividend payments. So at 60% weight on that, that gives us 14.4. So our after-tax cost of capital on a weighted basis, otherwise known as our weighted average cost of capital, is going to be 16.37% here. Using that rate, we apply our capital budgeting decision rules. And what we see is that we get, at this 16.37% rate, a net present value which is positive of $145,803. That's good news. That's a green light for the project. We also have an internal rate of return of 22%, which is greater than our weighted average cost of capital of 16.37%. Our modified internal rate of return is also greater than our weighted average cost of capital. It's 20%. Our payback period is 4.95 years. We want, let us say, a payback of no more than 5 years. We would consider this to be a good measurement. Our discounted payback is listed here, and our profitability index is listed there. Based upon a capital budgeting decision policy where, for example, we want only those projects that have a positive net present value and, let us say, a payback period of not more than 5 years, this would be considered a good project. So let's summarize the situation. We were given some assumptions about buying equipment for $450,000. Those assumptions included sunk costs, externalities, opportunity costs, future revenues, working capital requirements, salvage values, tax rates, percentage funded by debt and equity, and the cost of each. And we then looked at our income statement from the project over a 9-year period, and then made adjustments to those numbers to get free cash flow used for capital budgeting purposes. We applied our capital budgeting decision rules and saw we had a positive net present value, an internal rate of return greater than our weighted average cost of capital, and a payback period that was less than our maximum allowed payback period, all of which indicates that, at least for these financial capital budgeting decision tests, this is a go project. It is a green light. I would hope that you would take a look at this, look at the cells within the Excel schedule, and take a look at how these particular items are computed and what the schedule is telling you. Again, in a summary fashion, not all cash flows are relevant to the capital budgeting decision, and not all items on the income statement are relevant to the capital budgeting decision. In addition, there are items such as externalities, opportunity costs, that need to be included in the schedules for capital budgeting decision purposes that are not initially in the income statement. Thank you. Let us know if you have any questions concerning this.